All right, let's dive right in. We're talking about the bedrock of our entire modern economy, banking and insurance. Now, on the surface, they feel so solid, right? Almost immovable. But what's really going on underneath is this constant, high stakes balancing act between driving growth and managing risk, between making a profit and keeping us all protected. The whole thing really just runs on trust. We trust banks with our life savings. We trust insurance companies to have our back when things go completely wrong. But what is that trust actually built on? Well, it's not just a feeling. It's this incredibly complex architecture of rules, risks, and responsibilities that keeps the entire system from just collapsing. So let's pull back the curtain and see how it all works. So before we can even get into all the dangers and the safeguards, we have to understand what banks actually do, because they're not just giant vaults for your cash. They are, quite literally, the engine that powers the whole economy. At its absolute core, a bank is what we call a financial intermediary. And it's a really simple, powerful idea. Think about it. They connect people who have extra money, the savers, people like us with a checking account, to those who need money, the borrowers. That could be a family trying to buy their first home or an entrepreneur with a great idea for a new business. That connection, that's what keeps the gears of the economy turning. So how does that business model actually work day to day? Well, it's pretty straightforward. It all starts when you or I deposit our money. The bank is legally required to hold on to a little piece of that. That's what we call required reserves. But the rest of it, they don't just let it sit there. They lend it out. And the interest they earn on all those loans, well, that's the main way banks make their money. And this brings us to this really important concept called the net interest margin. It sounds complicated, but it's not. It's just the difference between the interest the bank charges on its loans and the interest it pays out on its deposits. So let's say the bank charges you 8% for your mortgage, but it only pays me 2% on my savings account. That 6% gap, that's their profit margin. And keeping that margin healthy is a huge, huge deal for a bank's survival. Okay, so that all sounds pretty good, but making money this way is definitely not a walk in the park. In fact, the whole business of banking is kind of like walking a tightrope way up high with some really serious dangers on every side. And this slide really shows you that landscape of risk. You've got the most obvious one, credit risk. That's just the chance that someone won't pay you back. Then there's market risk, because things like interest rates and stock prices are always changing. There's even operational risk, which is a catch-all for everything from a system crashing to an employee committing fraud. A really scary one is liquidity risk, the nightmare scenario where they don't have enough cash on hand when everyone wants their money at once. And on top of all that, you've got compliance and reputation risks, which can shatter that trust we talked about. It's a total minefield they have to navigate every single day. But here's the thing. All of those are, in a way, just business risks. What happens when the danger isn't about losing money, but about the kind of money coming into the bank? What happens when the danger is hidden inside the money itself? And that brings us to the shadowy world of money laundering. It's exactly what it sounds like. It's the process criminals use to take their dirty money from things like drug trafficking or terrorism and wash it so it looks like it came from a perfectly legitimate source. This is a direct attack on the integrity of the entire financial system. And it generally happens in 3 stages. First up is placement. That's just getting the dirty cash into the financial system, often by making lots of small deposits so nobody gets suspicious. Next comes layering. This is where they get clever, creating a super complex web of transactions, wiring money all over the world to cover their tracks. And finally, there's integration. That's when the clean money is used to buy legitimate stuff, like a fancy car or a piece of real estate, making it almost impossible to trace back to the original crime. So with all these risks swirling around, especially something as dangerous as money laundering, how is the system even protected? Well, this is where the guardians and the rulebook come in, the institutions and the regulations designed to be the ultimate safety net. Now, in the US, you've got 3 main players on the field. First, there's the OCC, the Office of the Comptroller of the Currency. Believe it or not, these guys have been around since the Civil War, and they regulate all the national banks. Then you've got the famous Federal Reserve, the Fed. They manage monetary policy, sure, but they also keep a very close eye on the banks themselves. And finally, the FDIC, which was created back during the Great Depression to insure our deposits. They're the reason we have confidence that our money is safe, even if a bank fails. And the rulebook they all enforce wasn't written overnight. It's constantly evolving, almost always in reaction to a major crisis. You had the Bank Secrecy Act back in 1970, which was really the first big step against money laundering. Then after 9/11, the USA Patriot Act gave those rules way more teeth to fight terrorism financing. And of course, after the 2008 financial meltdown, the Dodd-Frank Act came along and created a whole new world of oversight to try and prevent that from ever happening again. But all those big government regulations, that's only part of the story. The real fight against financial crime, the day-to-day battle, is fought on the ground, inside every single bank. This is truly the first line of defense. And it all begins with this idea called Know Your Customer, or KYC. This is probably the single most important tool they have. And it's so much more than just asking for your driver's license when you open an account. It's about a bank truly understanding who its customers are, what their normal financial activity looks like, and what kind of risk they might pose to the system. And here's the key. Banks don't treat every single customer the same way. It's a risk-based approach. So for most of us, they do what's called standard due diligence. But for customers they see as higher risk, think about politicians, their families, or maybe businesses that deal in a lot of cash, they have to perform enhanced due diligence. This means they dig way deeper, verifying the source of wealth and monitoring their transactions much more closely. It's all about focusing their energy where the risk is the greatest. So what happens if they get it wrong? Well, the consequences are staggering. This number you see here, this isn't made up. This is a real $3 billion fine that a major bank had to pay. Why? Because their own employees flagged a ton of suspicious activity, but the bank, as an institution, failed to act on it properly. $3 billion. That's the potential price of failure. Which brings us to one last really critical question for the future. Finance is moving at lightning speed now. We've got crypto, instant digital payments. Everything is happening in the blink of an eye. In this brand new world, can the old safeguards we've built over decades, can they possibly keep up? And that, right there, is the high-stakes balancing act of modern finance.